Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com. Now over to your host, Sparta co-founder and CEO, Felipe Sherman.
Welcome everybody to Sparta Market Outlook, your weekly snapshot of what's driving global oil markets. I'm your host, Felipe Sherman, and this week we're joined by Neil Crosby. Hi Neil, how are you?
Good, thank you.
And also from Vienna, Phil Jones-Lux. Hi Phil, all good?
Good morning. Yep, all good, thank you.
And still in Singapore, our good friend Jorge Molinero. Hi Jorge, how are you?
Hi Felipe, very well. Yeah, I came here for the APPEC and I don't want to go back, so I'll keep working from here.
You want to extend your summer and with the heat and humidity of Singapore. Good man. So I actually did come back with a red eye and all that, so I'm not feeling extremely fresh, but obviously APPEC is the big talk of this week, and we will address that. We will talk about what we heard, what the main, the gossip, the main views of the market, how we also have different views from the consensus. I think that's going to be an interesting debate. So maybe let's start from what we heard during APPEC. And Neil, maybe you want to start with, obviously, the risk of war and the supply disruptions. What can you tell us about that? That's one of the topics we heard.
Yeah, so there's a reason I want to start with that, and that's just to link back to some of the messages from APPEC, of course. But the week was kind of interesting for a couple of different reasons. The first one being there was obviously the Israeli strike in Doha this week, which, obviously stokes all kinds of fears about where the Middle East goes from here. Probably potentially overblown at this point in time, but just another point on the map in terms of geopolitics, let's say. The other one was Russia invading Polish airspace with a bunch of drones, and that was interesting for a couple of reasons, but one of them was just the relative weakness of NATO's response. That's been getting a lot of talk. So essentially, we did a crap job of defending that, and that was 6 drones or something, whereas Ukraine gets 600 drones a night, and we failed to deal with it effectively. And one of the sort of backlash of that is, well, Putin will just be emboldened by this whole thing. And that is just another pin in the map again, which just said all these negotiations are just not working, and Putin and Russia are just not responding to any of this stuff because they don't give a shit about our negotiations. Basically, they respond to what can they do, who has real power, and the point is another step up in geopolitical risk, and to remind ourselves that one of the only bits of leverage we have is on energy, and Trump will be thinking about that. That's also why Trump is asking the EU to step up sanctions and tariffs on India and China, who have formed this energy bloc, essentially. And I think it's just worth not forgetting that. And the link back to APPEC, to finish my monologue, if you like, is that everybody is quite bearish flat price because they have this mega long balance once again on the books. And the question also becomes, can you really be short when every other day there's a new bullish headline, or it's just a difficult environment to be super short and expect oil to collapse to $40 type thing? Yep. How do you guys feel about that? Is that fair?
Yeah, completely fair. I think we added in our presentation, we talk about the oil Glut, and I've seen that headline in many different presentations around here. So I think that was the main focus. Then a lot of conversations about Dangote, about Pernis, about the new strikes on Doha that happened during the week. But the main highlight was everybody was really bearish on crude at the beginning of the APPEC.
Yeah, I would say that it's interesting because the what I call the supply and demand fundamentalists were feeling very strong about this, about flat price collapsing and the whole story around there's just too much crude around, and that's it's a fact. I mean, I think that it is true. There's ample supply, but at the same time, there's a lot of other elements there that we'll talk about in a second. But at the same time, it felt like no one really wanted to go short. You see, there was this sort of high conviction of the supply and demand and low conviction in terms of trading position around that. I would say mainly because of the risk and the war risk that you're mentioning. Also, I think, and this is something not a lot of people admit it, but it's also a fact that we've been telling this story, the wolf, it's a bit calling the wolf since already October last year, that there's going to be an oil glut and there's just going to be too much oil. And every sort of couple of months, everyone is like, well, yeah, it didn't happen, but now it's going to start happening. No one really admitted that, but let's face it, it's been an ongoing discussion. And so, okay, we can talk about that later, but that's sort of the main topics were around flat price and just too much crude. Yeah, that's one of the main things.
Well, why don't we pick up on that just now? So we can try and discuss what we've just been discussing before we started to record, right? So let's just pick up on two things that did happen this year relative to where people thought we would be. And the one lesson is that probably some parts of the market are not doing a great job on balances, and that includes agencies who are to a certain degree also bound by what they're allowed to say in terms of Middle Eastern supply, to put it politically. And so the basis of us not being that bearish was simply, okay, look at OECD stocks, they keep on being tight, they're not building. The other basis was OPEC exports do not equal OPEC official targets. And it was almost that simple, right? And basically we just observe it every week. Does anything change? No. And therefore, can you be super bearish? Not yet. And ironically, now we're talking at this point in time, and I actually feel less convinced that the crude market is super tight because the prices have changed, right? Brent spreads are now 30 cents. They were 60 cents at the start of the month. You've got TI, which looks particularly cheap. The TI Brent spread is now minus 430 a barrel, which hasn't been the case in a long time. And we actually talked a few weeks ago, if there's a glut in light sweet, if there's a glut in the crude market, the marginal barrel probably will be WTI. And it's a tricky time to understand whether it's persistent glut because it's the turnaround season, buying is particularly weak. But there is some evidence. And if you look at US crude stocks, they didn't draw at all over the summer, which is a bad sign. But the other aspect of this is that there's lots of other tight parts of the oil market. If you look at Dubai, it's mega tight. That was one of the big topics of APPEC. If you look at margins, they're pretty strong. If you look at EBOB spreads, they were plus 30 yesterday. They're seasonally very tight. If you look at gas oil spreads, they're tight.
Spreads, yeah, same thing.
And something that we've been thinking about internally for a week or two is, or a bit longer, but it seems to be becoming clear, and that links back to Dangote as well. Maybe there's a real lack of spare capacity in the refining capacity, and that's why we simply can't tank the products market. And can you get a glut in crude but not in products? Yes, you can if there's not enough refining capacity. And I think that one of the main stories of the next couple of quarters, let's say.
Yeah, that's a good point. And again, I go back to, this is one of the things that always troubled me with the classic supply and demand vision is that, or the research is always, it's always about the supply story. People call it supply and demand, but it's actually just supply. And the demand is just, okay, we take the numbers from last year and we just do, 3% growth or 3%, that's it. And it doesn't really tell the real story here. We keep talking about Dangote, Dos Bocas, etc., but people tend to forget all the other refineries that shut down or are shutting down. And here the proof is in the pudding. Look at all these cracks and look at all these spreads and all the products. It's not just one. It's diesel, it's gasoline, it's naphtha. They're all picking up right now. I don't know about fuel oil, but and that's telling you a story. That is a demand pull. It is not. The crack is high, obviously, because crude being slightly weak, maybe, but it's also telling you that it's because the demand for products is strong, and we need to build those stocks as well. So yes, there was this constant sentiment, and again, one of the problems that I have with this sort of supply and demand, when in reality it's just supply, is that it gives you the sort of long-term perspective, but it never gives you the timing. It's we've been talking since October last year that, since October, I keep seeing a bank publishing a report or a competitor showing these, supply and demand balances. And it's always next month when crude stocks are just going to start rising dramatically to levels never seen. I mean, I've seen charts where you have this sort of 5-year, 10-year history, and the crude levels are going to be like double the amount of what we've seen in 10 years. I've seen those charts. And it always starts next month, and then next month, and then next month. And the reality is that it's not there, So that's something I'd like to investigate a bit more and call out a bit more, because it's just, to a certain extent, it's almost laziness. It's like I'm only looking at the market on a supply perspective, and I'm to a certain extent disregarding all the other elements.
Yeah, and it's also just, I mean, from our own perspective, keep an eye on the data. That's like the bare minimum you can do. But that's also why, I mean, up until now, it was very easy for us to say, well, look, OECD stocks, they're really low. How can we be bearish in this environment? And ironically, now that we're discussing it right now, like I said, I actually feel fundamentally slightly less bullish now. I think we've talked about post-summer as one of the timing, the key bit of timing, because OPEC can supply more after their burn season. They will export a bit more, generally speaking. There is some supply hike. And there is a problem in US weekly data, I have to say, with US crude supply, with US crude stocks, with US crude pricing. It's just that is the only weak part of the market, apart from high sulfur fuel oil, and the rest of the oil market looks tight still. So I agree, generally speaking, but I think our job is just to be honest and say, look, the data says this, and maybe now is an interesting point in time to talk about the glut. Just with one corner of the market.
No, but I mean, look, I just give you this little, anecdote. Rachel and I were sitting down with the head of research of an oil trading company, and he was complaining that everyone had the same view, and it's a classic thing you see in oil when research channels get together. Surprisingly enough, everyone has the same view, and then you have this herd mentality, and everyone positions themselves in the same way, and then one day it all goes against them. So everyone has had those experiences, and therefore they're never satisfied when there is no contrarian view. So Rachel and I were, giving our point of view. Everything you just said, demand is strong on the product side, refinery issues here and there, crude levels in OECD not being that dramatically high and all that. And his first initial reaction is, but what do you mean? I mean, haven't you seen the supply and demand? It's obvious, it was like a very knee-jerk reaction, like, how can you even say something different? And I'm like, but you just told us that you wanted to have a different view. We have, we're not giving you a different view because you asked for a different view. We're giving it because we see different things. Now, we're not saying that this is mega bullish, that's not the main, but we're saying, hey, before you end up in this rabbit hole following everyone into Brent is going to collapse $10 a barrel before the end of the year, which is something that was constantly said during APPEC, look at the data. Look at all these other elements that are telling you perhaps a different story. Now, will we end up in this final glut that everyone has been anticipating since October 24? Maybe. But can we are specializing ourselves here at Sparta on, the sort of M+1 to M+6 kind of environment, okay? So that means Q4, Q1 right now. And in that spectrum, we are seeing different evidence, different data.
Yeah, at least, more nuanced.
More nuanced. That's it. You are very articulate than I am. So yes, more nuanced. That's the right way of putting it. The other thing that we haven't talked is the China SPR. Now I know June talked about that during our presentation, and she published something. Can you guys sort of summarize what she was saying?
Well, it's just let's say a hot topic, and it links back to what we've already mentioned, which is one of the conundrums of the market over the last month has been the strength of Dubai, when fundamentally speaking, it should not be that strong. And if you link this back to the thing that we do as a bread and butter, which is the ARBs, all the West of Suez crude ARBs into Asia have been super open for weeks and weeks and weeks, and it didn't do anything to Dubai. And that is one of the reasons that fundamentally we're a bit confused. And there's a lot of talk in the market about what's causing this. A lot of it is the kind of trading dynamics stuff that we have less visibility on, but we can, mention as a factor. So Chinese majors basically buying for SPR, not coming out in the sell side in the Dubai market. And the question also becomes, will China build SPR into the next couple of quarters? Most people think it's true. I tend to agree it would make sense. The price is good enough. There's high geopolitical risk. I don't think it's contributing necessarily to the strength of Dubai over the last months because they've been building stocks for ages. So I don't understand what's changed unless it's the specific benchmark dynamics. But it is definitely true. If the Chinese would stop importing at these levels, it would be a big problem for the market. So if they decided to stop building SPR or stop building crude stocks, that would be a big problem because they have mopped up some of the length that was evident in the market this year.
Fair enough. And before we start talking about individual products, we touched it on this topic, but maybe we can elaborate a bit more on the, Russia, I would say more Indian sanctions on secondary purchases, all these sanctions that we've been, the US and Europe have been discussing around Russia or India. Anything to add on that?
I wasn't there with the discussions, but I can see that it's becoming more of a topic because the EU target is for January 2026 to probably ban Russian volumes that have been processed from crude somewhere else. But the question still becomes, how is that going to be possible? But we will be approaching in terms of pricing rather soon that point in time. So it is going to worry people. And I suppose that unless it's complete souffle from the EU and basically they end up doing nothing, it will actually be probably another bullish factor for distillate going forward.
Well, I don't know how where would you get the supply from if you stop importing from India? Or you get the same supply, but
it'll be going in different places.
Yeah,
first.
It just changes directions. But once again, this is another consequence of our extremely poor energy strategy over the last 10 years. But I mean, it was a surprise, when Trump started putting pressure on India immediately after India starts meeting with Xi Jinping in China and all that with Russia. It's it's one of these things where you wonder, okay, these are little pieces or little moves in the master chessboard that's going to take many years. When you study history and you look at the for example the big wars and all that, actually before the war started you had all these little pieces of the puzzle moving 3-4 years before. So China taking stocks and building stocks like that, is that a strategic move or is just a price reaction move? You see so many of these things that we might consider like uneventful or just economic can actually be much more of strategic ones, and we need to be careful about those things.
And it's only really just occurred to me, or maybe that just makes me look very stupid, but part of the reason that China have probably been building stock and not exporting lots of diesel is to help out some of their new formed partners, right? To try and support the oil price perhaps, or at least prevent it from falling through the floor. Yeah, it's possible. Maybe that's too early a thought. It's a morning thought, but
it's theoretically it's a bit similar to Saudi saying that they're going to export much more than what they actually do. If you think about it, economically speaking, why on earth would Saudi say Saudi? When I say Saudi, I mean OPEC. But it's like, why on earth would they say, well, we're going to export a lot? And then they don't, which is one of the topics that you were mentioning. It's like, in theory, they have no interest in doing that. The reality is that maybe it's also to please Trump and the relationships and all these things, So it's part of a bigger geopolitical chess game, Anyway, that's not our, we have an opinion like everyone and we share it, but that's not where our strength is. Our strength is Jorge and Naphtha. Jorge, what can you tell us about Naphtha specifically?
Okay, yes. I'm going to summarize our view, the things that we presented in our breakfast briefing, and some conversations I've had and some presentations from another people I've went. So looking at the market right now, we are seeing a very strong market. MOBJ cracks are trading in positive, which is something very unusual. And we came here with that idea, like East West is at historical highs for Q4, for Q1. We still think that Q4 is going to be tight because of the strong turnarounds in AG. And then during the week, we had the attack on Doha, which is the second biggest exporter into, Qatar is the second biggest exporter into Asian market for Naphtha. So it's a big deal. So the market has kept climbing, and that's our view for Q4. And I think, yeah, it's going well. It's not something we started, we thought last week. We have been saying that since end of August. We started to see the ARB wide open from west to east. The 25th of August was the first time we saw it on the ARBs. So we've been following that sign, and so far, yeah, it's working well. Some questions about when could it stop. The market right now is maybe a little bit overheated, and we've seen some premiums decrease, especially in Europe. So maybe the highest point will be reached soon. But so far, the outlook is constructive. And this is our view. As you have said, Felipe, we are focused 1 to 6 months, but I have a couple stories I've been talking, like more looking forwards. I think when the market is very strong, the people make a strong forecast for the very long-term future. So we've been hearing about next year being quite strong for Naphtha. The main point would be more demand from China, from the new steam crackers, and more supply from the US Gulf Coast of C5 due to the more shale production. So that will stimulate the flow from US into Europe and from US and Europe into the East. So it could be an interesting year. And I think many people was bearish on that point. And then just to finish with Naphtha, I want to talk a little bit about a very long-term vision that, I was talking in some conferences, and it's to start to see maybe in 3-4 years, Naphtha cracks in positive. So it not just being a byproduct with a negative crack, that it wouldn't make sense to distillate a barrel just for Naphtha, to a Naphtha on purpose outlook. And it's, the main fundamentals behind that would be a lot of new demand for steam crackers in Asia, mainly in China, and a refinery system that is not growing enough to match this growth in the petrochemical sector. And these are the 3 stories I have for Naphtha.
Okay.
That last story, the Naphtha on purpose, I remember giving a similar presentation back in, I think, 2018, talking about Naphtha on purpose, early 2020s. For the same reasons, right? Petrochemicals demand is growing, transport demand is not growing. I think the only kind of caveat that I would add on the Chinese Naphtha demand is that, I mean, the majority of those new steam crackers are coming as part of integrated setups, right? So it's not actually something that you need to price internationally, right? Yeah. It's something that is being supplied domestically and might not actually turn into higher Chinese naphtha imports. And at the same time, you've got the Koreans and the Japanese talking about closing steam crackers. So and the paper is linked to Japan and Korea and Taiwan. It's not linked to China really. That buys a lot from Russia. So I agree with your point. Yeah.
And what about gasoline?
Yeah. So on the gasoline side, the main talks we have been having were about turnarounds, Dangote, Pernis, and so on. The market is very, very strong, and we saw a very big change that make us, I did the presentation with Neil and Phil, so it's our view. We changed our view based on TC14 change just the days before the APPEC. So US Gulf Coast was very expensive into the Atlantic Basin, but then we saw a very big drop in TC14, and ARA started to be competitive into these outlets. What we have seen after that, I think the change in the delivery prices have been a very good signal. We have seen the TAR becoming negative, so much more strength on the European side than on the ARB side, and it makes sense completely with the arbitrage perspective that we were showing. And we've talked about being contrarian to the oil glut history, so we have a mixed view on the ARA complex for gasoline, because at the same time it's very tight. We have this turnaround unexpected that are falling the market, but on the other side right now we have the blending margins open, and not a lot of exporting opportunities into Latin America. So I think if you look at this perspective, you have the bullish signal of the turnarounds, but the bearish signal of the blending margin and the export. So kind of a mixed feeling. And then moving to the east, we have seen Singapore 92 very, very strong. Is that strong that is pricing into some outlets in the west? We were talking about it being very competitive in US West Coast, into Mexico, even improving a lot is the price into Nigeria. So that gives the opposite feeling than from ARA. So Singapore is becoming cheaper and cheaper, or with better delivery prices compared to the alternatives into Western outlets. And we have a turnaround season also in the east. So overall, from a statistical point of view, we saw a very big drop in the east-west, and I think it could recover in the medium term because we have this strong arbitrage outlook for Singapore and much weaker in ARA. So
you're seeing the signs of the early signs of a cap, if you want, on this rally, driven essentially by particularly when you look at the rally in ARA now, TC14 dropping. Which then means Gulf Coast is now cheaper and taking outlets from ARA, and ARA now being threatened by Asia and Singapore, Asia taking shorts wherever it can, particularly Mexico, West Coast, etc. So, would I go short now in September? Absolutely not, because then you have the trader positioning that you need to take into account, and if everyone is long September and they're going to defend that position for sure. Question is whether people were long in October. And I think that keeping an eye on October, and that it's going to be quite interesting, because if you don't have Sparta, you don't have that global view of what's going on, you tend to fall in love with the current rally and the whole refinery story, and it's going to happen again, and we're just going to be rolling backwardation and all that. But if the flows are actually happening and you see, and the key element here is to look at the cash dips, okay? Yep. Because some people say, but Felipe, your thing is theoretical. It's not because it's open on, that it actually happens. So the counter argument to that is, okay, what's the cash dip telling you? And we had one customer yesterday saying, with the cracks rallying, shouldn't the blend margin change and all that? But the 92 went up, but the reality is that the cash dips went down, and that is the telling story, is that yes, the paper story is there, the bullishness is there right now, but you're starting to see those signs where cash dips are coming down, and you have positive blending margins across the board, and those guys in ARA, they're already looking at what am I going to do in October. And when I look at what's my planning going to be in terms of exports to the US, to Latin America, to whatever, and there's no demand because it's been taken by someone else, and I see that my EBOB blends are now positive, I would be a bit cautious about October.
I do have a little bit of a caveat there, or maybe a slightly contrarian view, and it's come because I've been stung all through the summer on this, and it is that those EBOB blend margins have been open for a long time now, and we've rallied into them. And so, typically over the last few years, you'd always look at it and you'd say, E10 blend margin, E5 blend margin is open. That must be bearish immediately for EBOB. And we've instead, all through August, we just rallied and rallied whilst we had those open blend margins. And I think something that we need to maybe look at or think about in more detail going forward is, two things. One of them is relatively obvious. Dangote RFCC is offline. There is now an open arb into West Africa again. That's helping to tighten ARA. Obviously, there's also Pernis and Total Antwerp potentially offline. Pricing center issue there, and maybe it's just that actually we're not getting the typical refinery supply into the window, and so we can sustain an open blender margin to supply the window for longer. And when does that stop, right?
I agree. The question mark, that then you also need to look at what were the spreads at the time, what are the spreads today?
Yeah.
Okay. So so that's you only. Today you can only trade where the market is, not where the market was. I'm just saying, given, yes, at the time, yes, you may had good positive blending margins because cash dips were perhaps depressed and it allowed you to, but you then had the demand pull. And that reduced the stocks, and that elevated the rally and all that. Now we've got to the rally. Story is what happens from here.
Yeah.
And when you are from here, you see, yes, on the positive side, that the supply is not going to be pushing and telling traders get rid of the product. So that's one thing. The other one is, well, actually, there's no outlet for me to get rid of. There's no directionally where I can get rid of it. So that's why I'm calling it sort of like the early signs of a cap. I'm not saying it's a bearish, but it's an early sign of a cap. So before you fall in love with this whole, it's going to be a rolling backwardation scenario, start looking at those early signs of cash dips and outlets.
Yeah. One funny thing about this is that we finish our presentation here with like our positions for the short term, and I had a position in ready to say about ARA complex, ARA, but I changed it to East West because I didn't want to go against the turnarounds in Northwest Europe and Dangote, so I moved for a position in East West. Yeah.
And it's paid off already. And actually, I think if I may just obviously I wasn't at APPEC, but I know that we were contributing to putting the slides together, and I think we started putting them together maybe the second half of last week, and there was a nice, just talking about distillate now, there was a call on East-West looking like it was a buy. So the ARBs were very open from the swing ARBs were very open into Europe. Everything was pointing towards Europe. Singapore was unusually pricing weekly. So East-West was a buy. By the time you guys came around to actually presenting, that had already moved by over $5 a ton. The price movement had probably already happened. And so from where we are right now, I think maybe we talk about it again in a second. But from where we are right now, actually, it's already turned around, and maybe we can be short East-West again because those ARBs have changed so quickly. And I think it was just an interesting kind of maybe angle that we have when we're talking about what do we think is going to happen in the next week or 10 days. It's very difficult to put some slides together for a presentation in a week or 10 days because they already have happened.
That's why we have the snippets and the podcast. Yeah.
Exactly.
Guys, we're just conscious of time. Distillates, there's also a story there. Phil, maybe you want to cover that?
Sure. So just not necessarily talking about APPEC or anything, but just where we see it right now. The HOGO has come off. It's been helped by RVO levels coming off, but about 2 cents per gallon of weaker HOGO, 1 cent per gallon of that has been the RVO. And TC14 coming off slightly has almost opened that US Gulf Coast MR ARB into Europe again for October. Specifically for November, December arrivals, it still looks very, very shut. If we look at the other kind of side of the equation for the ARBs into Europe, the ARBs from the east they were very, very workable for arrivals in September, for arrivals kind of first half of October, now looking much less so. As we mentioned before, the East-West rallied somewhat. So there's a lot of volume on water already. It's keeping kept the expiry relatively subdued. Now we're going to be rolling into that the next prompt spreads, probably also some prompt bearish pressure from high arrivals coming from the east. But if we look right now, again, if we're looking for ARBs that are arriving second half of October into November, the ARBs are very shut again. Those swing ARBs out of the AG, India, they're pointing east again right now. So I think we haven't gotten too far away from the idea that we still have relatively well supplied European market as we go through this kind of peak of turnarounds. And then as you get towards, let's say, further deeper into Q4, maybe the pricing as it is right now isn't quite where it would need to be to keep Europe supplied well into or through Q4.
Okay. I guess that leaves us with crude. Neil?
Yeah, I'll go quickly. Just two quick fire ones on crude. The one is a similar, same old story as the last couple of weeks, the Brent-Dubai spread. I just wanted to say, after all the talk, we haven't reached any change consensus. I can just say that fundamentally speaking, the thing looks like Dubai is massively overvalued. I can't really account for what might be happening within the benchmark itself over the next couple of weeks, but that seems to have been one of the main issues with Dubai recently. But the ARBs are all open east. You can see that there's a bit of early data that maybe the Saudis are exporting a bit more in September post crude burn. We know that the allocations to China have been ramped up month on month, and the OSPs were dropped, so you tend to get more demand for term crude, less demand for spot crude. All those things speak for Dubai easing. So I think the story is the same. I don't know about timing because the timing didn't work out at all over the last month. So I'm not going to say, okay, this week's the week. But it still seems, fundamentally speaking, Dubai needs to cool. The one thing I'm toying with this morning is the WTI-Brent spread. So that's something we picked up on about 45 minutes ago now. WTI-Brent is the one, or the WTI is my main concern with the oil market in terms of the glut versus non-glut story. And the WTI-Brent spread for November is now minus $4.30 per barrel, which I didn't expect, I have to say. I thought it would stay at $4 or maybe even narrow a little bit over the last couple of weeks, and I got surprised. And I think it also follows the logic that we actually talked about a couple of weeks ago, but I didn't fully believe the extent to which it might actually be playing out. And that is the fact that US crude stocks are rising, or they are not drawing, which is a problem, and it's been like that for several weeks. And if that happens, TI becomes like the least economic barrel. It becomes the marginal barrel in the world because it's a light crude, it's high supply. And I think that's what's playing out. And the problem now is that was during the summer. And now we're approaching turnarounds when US crude stock builds typically rise, or US crude stocks would start to rise seasonally because there's less demand internally. So I just think, maybe it's more of a trend following argument because I've seen that I've been wrong. But maybe TI is not cheap enough yet, and there's more fundamental pressure ahead. And one, let's say, supportive argument for that is just looking at TI landed values in Europe, which are still not cheap, despite current spreads, despite the fact that MEH premiums have come off quite a lot. It looks like it needs to get cheaper, and the fundamental pressure's there. So maybe WTI-Brent can start to go out to sort of minus $4.50 in the next couple of weeks. And I think that makes sense. I've been wrong, and maybe I need to sort of double down on the direction it's going. And it just occurs to me that there is a step change in what the fundamentals data is saying, and when that happens, you can get price that is relatively novel, right? Minus $4.50, I wouldn't have thought possible, but maybe it is possible in the next couple of weeks, and the timing seems right just now. So yeah, that's the main message on WTI-Brent.
Okay, well, I think that wraps it up for this week. Guys, thank you very much. It's been a pleasure. Don't worry, Rachel's coming back next week. But yeah, interesting week at APPEC. It was great to see a lot of customers, a lot of market participants. Mood is picking up for sure, relative to the first half of the year. That was quite terrible. So let's just hope it continues that way and people keep making money. Thank you very much, and see you soon.
Thanks very much.
Bye-bye.
Cheers.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.